Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we want to look at something new. We want to continue with the elements of cost of capital, elements of cost of capital. The elements of cost of capital are only two. These elements are only two. We usually say that cost of capital is made up of two elements, and these two elements include what we call the risk-free rate, which we abbreviate as RF. And in most cases, this risk-free rate is represented by the treasury bill rate. Is the treasury bill rate, or what you call the central bank rate, or the CBR rate, the central bank rate. So when you hear the government of Uganda, or of course the central bank, that's the Bank of Uganda, and you hear that the Bank of Uganda has issued the CBR rate, or the central bank rate, because this CBR rate is the rate at which these commercial banks are going to borrow at. Is the rate at which the commercial banks must be lent at, or the rate at which they must borrow at from the central bank, is the borrowing rate for commercial banks from the Bank of Uganda. So it is always, in the most cases, the treasury bill rate, which is the one that we call the risk-free rate. In other words, an investor, it's the rate an investor would get without any issue to do with risks. That's the rate an investor is willing to get without any risk. So it's like the nominal rate you are supposed to get without any risk. However, when it comes to cost of capital, if you go to the commercial bank, you find that how the guys in the commercial bank, how they arrive on their cost of capital, how these commercial banks are going to arrive on their cost of capital, or what we call the borrowing rate. They pick what we call the risk-free rate, and then they add, of course, they add what we call the risk premium, if any, because they may not be there, if any. Now, that's how the commercial banks will arrive to their cost of capital. They get the risk-free rate, that is the rate at which they borrowed at, plus the risk premium, if at all it is there. Therefore, that's why we are saying that cost of capital, we have what we call the risk premium, and a risk premium is a return to compensate for the financing risks, or the gearing risk that we've been talking about. The risk associated by giving out the money, So the risk premium is the return to compensate for the financial risks of having debt in your capital structure. Once you have debt, then we are going to face a challenge of whereby the risks are going to be high, because if we don't pay the debt, the lenders can actually take up our company. If we don't pay them, the interest is going to be accruing and we'll be getting interest or arrears and some other penalties. So what is going to happen is that you will earn what you call a risk premium for as long as you use debt in your capital structure. So that's the amount, that the return you are going to earn for the risk that you have taken to include debt in your capital structure. So once you have debt in your capital structure, then you qualify for what we call financial risks. But at the same time, the risk premium compensates for what we call business risks. So the risk premium compensates for what we call financial risks, and at the same time it compensates for what we call the business risks. So once you have debt in your capital structure, then you automatically qualify for what we call the risk premium, because it is what is going to compensate for the financial risks of you having debt in your capital structure. But we are also saying that that same return is going to cater for the business risks. We've known that financial risks only comes as the moment you include business, as you include the debt in your capital structure, or you use debt in financing the operations of the business. But at the same time, we are saying that the risk premium compensates for what we call the business risks. Therefore, that makes the cost of capital, the whole cost of capital, or the overall cost of capital, of the business to actually have the two elements. So that makes the overall to be a combination of both the risk-free rate and what we call the risk premium. As I said, it will be hard for a business to actually go and borrow from the Bank of Uganda. It is impossible. It will be only the commercial banks that are going to borrow from the Bank of Uganda. So what that means is that the business itself will not utilize what we call the risk-free rate alone, meaning it will be only the commercial banks. But since commercial banks use money to trade as their inventory, what they are going to do, they are going to make sure that they get what we call risk premium. They are risking their money to give it out in debt. So you will find that what is going to be charged from your company as you borrow money from the bank is different from what these banks are actually getting the money from the central bank. That's how it operates. So the reason as why they are including the risk premium is to cater for both financial risks and then the business risks. Now, these are going to help the business as a business. Once you include debt in your capital structure, you have brought a problem, because you are supposed to be paying interest on the money they have given to you. Why is it a problem? Because it is a problem. Once you don't pay, the amount will keep on accumulating and you'll be paying arrears and penalties on arrears and the normal payment if at all you don't pay on time. It's not the case with the equity shares, because for equity shares, even if you don't pay, it's the management to tell that we have made maybe such and such amount, then let's declare that we have we are going to be paying dividends to our shareholders, which is not the case here. When commercial banks are giving out debt brings in to itself, it brings risk of you not paying them. That's a financial risk. They are risking their money to you. And also once you include it in your capital structure, it brings what we call financial risks, because you are at stake of losing the money if at all you don't pay on time. But at the same time, we are including the fact that we are also compensating for what we call business risks. And the only compensation that does the two is what we call the risky premium. So, the conclusion is that for the cost of capital, for the overall cost of capital, is going to we are going to be having what we call the risk-free rate plus the risky premium. But if you look at the capital structure, specifically the long-term financial instruments, in most cases, these are made up of ordinary shares, and then of course, the ordinary share from the equity perspective, then the debt finance. So this is what you are going to understand. This risk-free rate and the risk premium, they are only on the debt aspect. But in a capital structure, we have a combination of different financial sources. We can highlight some of them. You'll find that in your capital structure, you have what we call common stock, or what we refer to as ordinary shares. 2, you have what we call preference shares. You may have what we call debentures or bonds. And at the same time, you can be having what we call term loans. And sometimes we may be having something to do with retained earnings. So you find your capital structure has all these items. They are the ones that you are using to make the investment. Therefore, these are the long-term financial assets that we believe are making up the capital structure in terms of the long-term financial services. Now, we are looking at the capital structure. Sorry, we are looking at the cost of capital. And it's important we look at the cost of each of these long-term sources of finance that we use. So we want to look at what is the cost of using what we call, of course, this one we always compute it as cost of equity. We want to look at what is the cost of each source, what is the cost of equity, what is the cost of debt in their composition. What is the cost of term loan, what is the cost of debenture, what is the cost of a bond that you have used in your capital structure. So once we combine all the costs for the different financial sources or financial instruments, then we can have what we call the overall cost of capital. So the cost of capital does not necessarily include one single source. So we need to know how to be able to get the cost of using each item. What is the cost of using ordinary shares in our company? What is the cost of using debentures, the bonds, preference shares in our company? Because at the end of the day, if in my capital structure, I have a mixture of equity and debt, as you are seeing here, then it will call for me to know what is the cost of each of those items. Because remember, when you're borrowing this money, you are going to be assigned different rates. Even banks charge different rates based on which type of loan that you are taking. Even if it is a salary loan, you can find a salary loan in Standard Chartered has a different interest rate as compared to that same salary loan in, let's say, Stanbic, Post Bank, Housing Finance, and all that. Why? Because they are looking at the different risks. Everyone is incorporating in the different risks, but they are also looking at how they can competitively compete for the same customers. Now, once we put all these costs of each individual source together, it forms what we call the weighted average cost of capital, or WACC. And this WACC is what we call the cost of capital, the overall cost of capital for the entire organization. Now, for me to compute what you call the WACC, or the weighted average cost of capital, you need to first know the specific cost of each source of finance, or each element. When we talk about the elements of cost of capital, we are actually looking at the specific cost of each of those financial instruments that we have used in financing the operations of the business. So, for you to be able to compute your WACC, we need to first know the specific cost of each element. And that's where we shall need to know how do we compute the specific cost of common stock, the specific cost of debenture, and the examiner will not examine you on this. But the question we do, they originate from here. So if you don't know what we are talking about, how to compute the specific cost of each of these items that we are using in our capital structure. Remember, we said the capital structure is just a mixture of different sources, mixture of funds that are being used in an organization. So we need to know the specific cost of each of these items. If at all you don't understand, because we are basically using the knowledge that we learned from our level 2 financial management. If you don't actually know what we are talking about as per this level, then it's going to be a little bit hard if at all we go to Kapam. It will be a little bit, you will struggle. But we are going to make sure that at least we analyze things to the point that everyone can be able to understand. So just stay connected. So we want to start with cost of equity. So the cost of equity is something that we are going to look at in the next video. We try to understand how do we be able to compute the cost of ordinary share or common stock. Let's meet in the next video as we are talking about that in detail.